If China decides to support Iran in a war against the United States, the impact on the U.S. economy and the stock market could be significant. Financial markets react very quickly to geopolitical tensions, especially when major global powers are involved. Because the United States and China are the two largest economies in the world, any direct or indirect conflict between them creates uncertainty that investors strongly dislike. First, the immediate reaction in the U.S. stock market would likely be volatility and a sharp drop in prices. When war risks increase, investors usually sell risky assets such as stocks and move their money into safer investments like U.S. Treasury bonds, gold, or cash. This process is called a risk-off move in financial markets. If China openly supports Iran, investors may fear a larger global conflict, which could cause a rapid decline in major U.S. stock indexes such as the S&P 500, the Dow Jones Industrial Average, and the Nasdaq. Technology stocks might be hit the hardest because many American tech companies depend heavily on manufacturing and supply chains connected to China and Asia. Second, one of the biggest economic risks would come from energy markets. Iran is located near the Strait of Hormuz, a very important route for global oil shipments. If conflict spreads in that region and China becomes involved politically or militarily, oil prices could rise sharply. Higher oil prices increase transportation and production costs for companies across the United States. When business costs rise, profits often decline, and investors usually react by selling stocks. Rising energy prices can also push inflation higher, which may force the Federal Reserve to keep interest rates elevated for longer. Higher interest rates tend to put pressure on stock markets because borrowing becomes more expensive for businesses and consumers. Third, global trade and supply chains could be disrupted. The United States and China have deep economic ties through trade, manufacturing, and technology supply chains. Many U.S. companies rely on Chinese factories or components produced in Asia. If China supports Iran during a conflict with the United States, trade restrictions, sanctions, or even partial economic decoupling could accelerate. This could lead to shortages of important goods, delays in manufacturing, and higher costs for American companies. Industries such as electronics, automobiles, semiconductors, and consumer products would likely experience disruptions. As a result, stock prices in these sectors could fall significantly. Another important factor is investor confidence. Financial markets depend heavily on stability and predictable economic policies. A conflict involving the United States, Iran, and China would create a high level of uncertainty about global economic growth. When uncertainty increases, investors become more cautious. Large investment funds, pension funds, and institutional investors may reduce their exposure to equities and shift capital into defensive assets. This shift can cause broad market declines and increased volatility. There is also the possibility that government spending would rise sharply during such a conflict. The United States might increase defense spending, support allies, and fund military operations. While defense companies could benefit from higher military budgets, the broader economy might face challenges if government debt increases or if economic resources are redirected toward war-related spending instead of growth and development. Historically, large-scale geopolitical conflicts often lead to short-term market declines, followed by uneven recoveries depending on how the conflict evolves. However, not all sectors of the stock market would necessarily suffer equally. Some industries historically perform better during times of geopolitical tension. Energy companies can benefit from rising oil and gas prices. Defense contractors often see increased demand because governments spend more on military equipment and technology. Precious metals such as gold may also rise as investors search for safe haven assets. On the other hand, growth sectors like technology, consumer discretionary, and global manufacturing companies may face stronger downside pressure. In terms of how damaging this scenario could be, the impact would depend on the level of China's involvement. If China only provides diplomatic or limited economic support to Iran, the U.S. market might experience a moderate correction and increased volatility but could recover over time. However, if China becomes directly involved in a military or major economic confrontation with the United States, the situation could be far more serious. In that case, global markets could decline sharply, and the risk of a worldwide economic slowdown or recession would increase. Overall, if China were to support Iran in a war involving the United States, the U.S. stock market would likely face strong pressure in the short term, with volatility, falling stock prices, rising energy costs, and disrupted global trade. The longer the conflict lasts and the deeper China's involvement becomes, the greater the potential damage to financial markets and the global economy.